I feel like we could have had more fun having this conversation in December with everything that happened then. But
thankfully, we were not.
Let's talk about the now. The Fed yesterday warning that there was some new risk in the credit markets. A lot of the high-risk borrowers seem to be the ones taking on new leverage loans. Is that something we should be concerned about?
Well, first of all, I want to say thank you for being here. This is our 4th annual Leveraged Finance Conference for the firm, and we've got over 800 issuers and investors, and we're pretty excited to have folks up 13% in terms of attendance. On your question, there's a lot of talk about that. In fact, one of the panels I was just on with the head of loan sales, or loan portfolio management for PIMCO, raised this point. And the thing to think about is, while yes, borrowing is up, and particularly the leveraged loan market is higher, that is the most secure part of a capital structure. And so if you think about credit risk, senior secured is where you probably want to live.
Vivek, comment on this, because one of the themes that's driven this, of course, has been the sort of lack of regulation, or at least the winding down of some of the regulation. Again, is that something that is causing more risk to come into the market and perhaps more unchecked risk?
Well, sure, it's a fair point. The market has evolved, and so on the one hand, leverage has sort of crept up over the last 10 years. It is, and so on the one hand, leverage has crept up, and Cov Light has become sort of market standard, and so there's less covenants. On the other hand, the equity check as a percentage of enterprise value is actually still quite robust. It's in the low 40s on average. There's obviously variation around that, and some deals get done much more aggressively. But equity is a bigger portion of the capital structure than it used to be, particularly in 06 and 07. And then second, coverage ratios are more robust. To your point about regulation, so the leveraged lending guidelines has had the effect of pushing some of the most levered deals, call it that top quintile of levered deals, those deals that are 7.5 times and higher, out of the regulated banking kind of broadly syndicated market into direct lenders. And so the direct lending community, which was a very small part of the market 5 years ago, is now, call it 20% of the market.
Right, and holding steady. So, Christina, let me ask on that. If we're seeing this sort of robust direct lending market, and it's also becoming more diversified, right? Yep. It's not just one kind of alternative credit. Are they set up to actually deal with any kind of downturn or any sort of squeeze in the credit market? I worry that maybe the liquidity is just not there if we do go into a down cycle. Well,
they have long-term capital, so that's a positive. They do take on very large positions, and so it'll be very interesting to see from a liquidity perspective if there is a downturn, if they have the desire and the stomach to hold their positions, and particularly if they've bought into some of the less liquid names, will there be a market made for them? So we're going to watch it very carefully, and a number of the accounts ask that question repeatedly of our firm. So it's something to very much keep an eye on.
Okay, and one of the biggest, if you like, leveraged acquirers of recent times, or at least one of the most high profile, has been 3G. We've seen a kind of philosophical implosion of their model in recent times. What does something like that mean more generally for leveraged acquirers when they're looking to go out and do M&A?
Well, I think, capital has been very available, and certainly cost of capital has been very low. And so, I think, corporate clients in particular, and they function as a bit of a hybrid. They maximize their cost of capital with the most cheap forms of capital, and so I think they've pushed leverage very high. I don't think it really affects the leverage finance, single B part of the market as much, because they tend to play in more of the higher double B, but they're doing very large transactions, and I think we have to keep an eye on kind of all segments of the market.
And the very large transactions are coming from where? Because PE, we know, has sort of struggled in this market, at least to do traditional LBOs. There have been smaller deals, carve-outs. So where is that flow coming from, and where is it likely to continue to come from?
Yeah, it's a fair point. So to your point, so far year to date, we've not seen as many bigger deals announced. I mean, some of the big deals that have gotten done were deals that were signed up in the third and fourth quarter of last year. And so we're not seeing a lot of activity yet on the big deals. Now, part of that is, as you started the interview in December, we had a slowdown. And so when you have a slowdown like that in the market, dialogue slows down. And so we are starting to see a return to the smaller deals. So those $1 billion and smaller deals are very, very active right now. In fact, more active than last year. I'd say $1 to $5 billion deals. There's still a bunch of activity on those bigger deals, though, yet. That's taking a little bit longer to come back.
I would say with the amount of private equity raised, last year was significant, over $800 billion. There's a lot of dry powder sitting in those coffers. They are very much poised to start looking at larger transactions. We haven't seen that yet, but we have an anticipation that we'll see more of that.
Okay, let's just wrap on this. There is this concern in the market, perhaps justified, that you have a lot of triple B credits out there, some extremely large. I think of Ford with about $150 billion of debt, for instance. If we do go into a period of contraction and you see some of those slip down into high yield, is the market actually there to absorb them?
I think what we'd watch very carefully, if that happened to occur, for example, in the month of December, with what the macros, what we were dealing with, the technicals there, that would have a pretty profound impact. But if it happens over time, I don't think we're too concerned about it. What do you think?
Yeah, I agree with that. I think you probably need two things to happen. That plus some other event that would cause a market, like the sum of those things, I think would be a bigger issue than just the downgrades by themselves.